Every month, companies spend billions on share buybacks. Last year alone, companies in the S&P 500 bought back shares worth over $812 billion. As investors, our holdings can be drastically affected by these buybacks, and keep watching to see how upper management can use share buybacks to trick the market and fill their own pockets. In theory, share buyback is a simple concept. Any public company can use their funds to buy its own publicly traded stocks. They can do this either by a tender offer, where they reach out to existing shareholders to see if any of them want to sell their shares to the company at a set price. Or like you and me, they can go on the open market and buy shares from brokers like Robinhood, TD Ameritrade, etc. A stock buyback can be done for several reasons, and most of them benefit the shareholders. For example, let's say you're invested in Company A and you own 100 shares at $100 a share. Company A has 100,000 shares outstanding in the market and has recently announced that they are going to buy back 50,000 shares. This buyback benefits you in two ways. Firstly, by the company buying half of the shares outstanding in the market, suddenly the supply of shares was reduced by half. But people still wanted to invest in Company A, so consistent demand will lead to new investors paying a higher price as they are competing to invest in Company A. This increased competition directly increases the price of the shares and can easily increase the value of the 100 shares you own. Prices increasing due to the buybacks are sometimes preferred by investors compared to them getting the same amount in dividends. The reason for that usually is that dividends are taxed the same year they are received by the investors, whereas capital gains can be easily deferred till the investors want to sell their shares. For all this benefit, you, as an existing investor, didn't do anything, and the second benefit is effortless as well. Stocks you own represent your ownership in Company A. So after they decided to reduce the outstanding shares by half, your ownership doubled from 0.1% to 0.2%. This increase in value is very important for the fundamentals of the company. One of these fundamentals is EPS, or earnings per share. As the name suggests, investors use EPS to see the company's profitability per outstanding share. So when Company A made $10 million last year, their earnings per share was $100 a share. And this year, when they reduced the outstanding shares to 50,000 with the same $10 million in earnings, the EPS goes up to $200 per share. You might think that this massive increase would be obvious and investors will notice that right away. Well, in the real world, the buybacks happen bit by bit over the years. So if you as an investor weren't aware of the buybacks of every company you own, you could see a steady increase in EPS and not suspect a thing. But why is the EPS number so important for these companies? Well, a higher EPS not only increases investors' confidence in the company, but also helps the upper manager get richer. A lot of CEOs, CFOs, and so on of these companies have their compensation tied to the EPS, or share price. On top of their salaries, if the company hits its EPS targets, it can open them to extra bonuses. And we all know that at the upper management level, it could mean millions extra every year. These managers could have a direct incentive to approve the buybacks and increase EPS and share price without even thinking about the investors. In a healthy business, even if this decision was made because of greed, as long as the company used its own money to buy back stocks, then you are still getting some benefits with no hard loss. But unfortunately, there have been scenarios where companies have borrowed to fund these buybacks, which exposes the companies to additional risk and overall weakens the business. Company A doing stock buybacks from its own funds can be seen as a big green flag, as the company is strong enough to have cash to buy back these shares. And if the company has decided to invest in themselves, then why shouldn't you do the same? But on the other hand, investors should also be aware of what this money can be used for. Money spent on research and development or buying other companies can be very lucrative for business in the long run. Imagine if Apple didn't spend the money to develop the first iPhone, or Google didn't spend the money to buy YouTube. As investors, what would you prefer? A couple of dollars today, or the potential of your whole portfolio to double over the years? Year-over-year companies have either chosen to do bigger buybacks or simply hold cash. Neither of these are inherently bad, but looking at how much the digital revolution has changed our lives in the last couple of decades, if these publicly traded giants reduce funds going to acquisitions and R&D, it not only slows the money supply in the form of salaries and revenue for that departments, but also could reduce the development of new tech and products. Every company has its own reasons and full story on why they are spending billions on stock buybacks. The biggest buybacks have been done by Apple, where they spent over $80 billion a year on buybacks. Many believe that with slowing growth and access to cash, the company was able to keep growing the stock by fueling the growth in EPS. What do you think? Are they boosting EPS or investing in themselves? If you enjoyed this video, then you might enjoy these as well. Thanks for watching.